Yesterday I was asked about unusual put activity in Fastenal ahead of their sales results, which are going to be coming out tomorrow, and also what kind of option strategies might be used in either Tapestry or Capri, depending on whether one thinks the deal might go through or might break, or just to play it both ways potentially, depending on one's point of view. And we're going to talk about that today during open market hours on Open Mic Livestream, today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic while the market is open today, as it happens, partially because yesterday a couple of you asked questions. One was about the unusual put activity that we saw in Fastenal, and another question, which I thought was a good one, regarding the Capri-Tapestry merger. Let's talk about that second one first. So I hadn't really spent a whole lot of time, honestly, looking at that deal, sort of the consumer discretionary space. And actually, I was surprised to see such a huge discount attributed to the FTC's involvement in that transaction. So Tapestry has been essentially, building their business, and in part, I guess, the logic from the FTC's perspective would be through acquisitions. And their concern is that if they acquire Capri, that they would end up having a monopoly on affordable luxury, particularly things like affordable luxury leather handbags. This is a rather interesting area, I would have to say, when I think about the ways that our government could deploy its resources, worrying about whether there is a monopoly in things like Coach handbags. But the fact is that they did involve themselves. If you go to the FTC's website, as I did between yesterday's live stream and today, you can see their initial filing and a lot of things since. The most recent of these, which I think was, the last week of August, was mostly just an update on some of the legal proceedings. It didn't really have anything too material. But it was that affordable luxury monopoly concern that the FTC expressed when they first lodged their complaint, if you will, against this merger. Now, the question specifically that had been asked, and I'm going to see now whether, so I'm going to see if I can actually pull up that question, or I don't know if somebody actually has a copy of it. Hopefully you do. If you don't, I'm going to find it and just read it. Yeah, so, okay. So we're going to get the Tapestry question put up. So here's the interesting thing. As I pointed out, in an all-cash transaction, which is the proposed deal, so Tapestry would be acquiring Capri for $57 a share, all cash, deal to close by year's end. As I pointed out, extrinsic premium goes to zero in that scenario. The options don't convert into options on NewCo or the merged company. You don't end up with shares of Tapestry as a result. So consequently, there's no extrinsic value to those options. So what that means is that if you're going to speculate on a direction, you really are trying to do so in a manner that minimizes the extrinsic premium outlay. So that's in the event that the deal goes through, right? Because that's when the extrinsic value essentially goes to zero. Now, there's a lot of skew, so market makers aren't fools. They know that the upside scenario is one where the stock will likely converge towards its $57 all-cash takeout price. And so my preferred mechanism to trade that would be to look out to end of year and do something like buy a 1-by-2 call spread in Capri for as close to zero premium as one could. That would see profits at about that $57 price, right? So a 45, 55, 52 and a half, something like that would achieve that. But because of the skew, because the market making community is essentially able to model these things as well. What we find is that there's not actually a whole lot of opportunity there. I'm going to illustrate that by just trying to construct that strategy. We'll just go out to December. We're going to look at mid-market prices. Bear in mind that in these deal names, the bid-ask spreads are fairly wide, so you're probably going to have to not just use limit orders, but probably work the order. You might even have to work it a little bit leg by leg to try to get these things off. The other market participants are going to be looking for a bit of edge. But let's just take a look at this for a second and say, okay, let's say that you bought a 42.5 call, and you can see that these 50s, let's see, are about 247. So if we do this on a 1/2 basis, okay, so you're going to sell 2 50s. And why am I doing that? Because if you could get that off at even, the upside break even would be 57.5 naturally, right? Because if you have a 1/2 call spread, the upside break even is going to be the distance between the first two strikes. So 50 minus 42.5 is 7.5, added to the short strike, less the premium that you spend on the whole package. So if I was able to get this whole thing off for even, then that upside would be 57.5. And what we can see is that actually you're going to lay out about 71 cents. So at the takeout price, now this expires, of course, before the end of the year, and we're targeting end of year close if it closes. What we see is that you get something that looks like this. That's not ideal because the upside break even is now 56.79. So if the deal goes out and it converges to that, it's not going to go right to 57. There's always probably going to be a minor discount to the cash takeout price. This is assuming that the probability that the transaction goes through is ever rising. So let's say you get up to 90, 92.5% probability that the deal goes through before year's end. It's not going to trade exactly to the stock price, if for no other reason that you don't even get the cash straight away. So there's always going to be a mild discount. The only time it would ever trade over is if somebody thought there would be an overbid. That's not likely to be a possibility here. So this is an example of the kind of trade that I'm looking for, but this one, as we can see, would not work because if you're looking to speculate that the deal happens, this wouldn't actually be profitable. So we can try to bump this higher strike up a little bit, but one of the things that we're seeing, okay, so here here's a situation where you collect a little bit of money, but you'll notice that, take a look at this break even, right? So the break even now is going down, and there's a reason for that. So what's happening is that the amount of money that you're making on the long call spread, so that's the 45.50, is capped at $5, and therefore you don't have as much upside. So the wider you can get those first two strikes, the farther that upside break even is going to be. So what we're finding is that due to the skew, the call skew being relatively steeply negative, is that there's not really a great way to play it to the upside. You can't really look to flies in this situation, I wouldn't think, in part because the what you're going to end up finding is that trying to get all of those legs off with the wide bid-ask spreads, chances are you're just not going to get a very good price. However, what I did find was that if you were taking the other side of it, so there's a lot of put skew, so the puts are trading over, or negative skew, we might also call that, so the calls are trading significantly lower than the puts. In theory, the 1/2 the other way might look a little bit more attractive. So we can actually take a look at that and say, all right, well, the stock's trading 35 and change now, so we're going to switch that to a put. I'm going to go over here, choose that, and now we're going to look for a put to sell. That's 845, so we're looking for something that is, in round numbers, about half of that number. Let me switch this to puts. So I'm looking for a put that's about half of that premium spent. And I can look to, for example, these 27.5s And now if I sold 2 of those, something rather interesting happens, right? So if you thought that it was going to get down to 20 or maybe a little bit lower, this trade works out a little bit better. The downside break even is actually 1865. You collect a small amount of premium at spot. So this is a situation now. So this actually looks like an almost perfect trade in theory. So we're going to talk a little bit about what's not perfect about it. I think it's a decent trade, and I think it's decent because, first of all, there was a target price in mind of about 20 bucks. The downside break even is below that. You're taking advantage of an unusual dynamic in the vol surface, which is that vols are, number one, elevated, and you're selling more options than you're purchasing, and there's still a little bit of skew in it. So both of these things are positives. What's the downside to a trade like this? Well, if the deal breaks, that could very well happen well before the end of the year. So that's the first thing. So the stock price could drop before that. And if you take a look at this, I don't know if you can see what my cursor is doing right now. I'm following the instantaneous P&L of the structure, right? So even though this is a trade that would see profits at December expiration, peak profits at the short strike, which in this case is about 27.5 bucks, and should in theory be profitable at any number above this downside break even of 1865, assuming we got it off at these prices. Instantaneously, it's a long delta trade. That means that instantaneously, if the stock falls, so too will the value of this structure. So that's a downside that's important to keep in mind. Another downside is that, unlike the situation where if you could get that 1/2 call spread off for something close to even, where if the deal is going to go through, vol is going to collapse because that's assuming that the cash takeout is going to take place, and therefore all the extrinsic premium in those options gets sucked up. That's not true here. In fact, the exact opposite is true, because if the deal breaks, then presumably Capri remains a publicly traded stock, and you are now net short options. The thing about that is, though, you're short them at a very high premium. That high premium due to the uncertainty, and I actually think that vol could still come in. So is this a perfect trade? It's not a perfect trade. Is it a decent trade to speculate on potential downside? I think the answer to that is yes, it is, especially if you can do, as this one is doing, do the trade for something that actually takes some premium in. And as you can see, this is a trade that actually would also profit very marginally, but it would still profit if Capri Holdings actually does get taken out. You're going to take in the $1.35 in premium. So the only place this loses is below 1865 and at expiration. And the way to think about it is you're taking in $1. The worst case is you're taking in $1.35 in premium-ish on a risk that you own the stock at 1865, a significant discount to where it is. Given, though, that we know why that would occur, which is that the FTC continues to pursue this action and it ultimately proved to be successful, and the deal doesn't go through. We can leave the debate about whether or not it makes sense for government resources to be dedicated to making sure that there's no monopoly in affordable luxury leather handbags to another day. Just the fact that I mentioned it, though, probably gives you some sense of whether or not I think that's the best possible use of their time and our resources. So moving on to Fastenal. Now, the reason that we saw that activity, my guess, so there was, for anybody who's joining me now that did not watch yesterday's live stream, there was a significant amount of September activity, September put activity yesterday. And it was these SEP 65 puts. We can see that the stock's actually lower again today, so that trade is almost certainly profitable. My guess was that that put buyer was speculating on the sales results, which the company is going to be releasing tomorrow. As I also pointed out, though, this is a stock which, and you know, this was a name I'd sort of been playing with many weeks ago, but it did have a death cross just relatively recently, where the 50 crossed below the 200. And so what I was interested in ahead of the sales results was, do we have any comps, any competition, peers to Fastenal that have given us any clues as to what the sales results might be? I didn't find anything too compelling on that side, but what I did find that was interesting, and I think does potentially present a little bit of a trade, was in Grainger. So W.W. Grainger competes with Fastenal. They are not going to be releasing sales results. But what is interesting to me is that this is a company where the stock has held up a little bit better than Fastenal's has. So where Fastenal, the fire has already started or the bomb's gone off, however you want to sort of, whatever analogy you want to choose. Fastenal's a situation where we already had that death cross, and technically it's already broken. This is one where we are off of those all-time highs, but it might be possible to get ahead of this one. So let's just talk a little bit about Grainger. So a while back, the company had forecast that they were going to be seeing 8 to 10% annual growth. This seems awfully ambitious, particularly when we see data that suggests, in things like industrials and manufacturing, that activity is slowing down and may actually have been slower than some people had previously thought that it was. Company is going to be reporting earnings in late October. I think you would want to capture that, but an interesting thing to do potentially might be to bet well in advance of that, partially on whatever Fastenal sales results might be. In other words, I'm not sure there's a huge opportunity for trading Fastenal at this point because, unless you're kind of leaning into the momentum, which is rather bearish here. But this is a name in W.W. Grainger, ticker GWW, where you might use Fastenal as a potential sort of canary for Grainger. Incidentally, in the Russell 1000, I was just taking a look at pairwise correlations, basically, for all of the stocks inside of the sector, the industry, the sub-industry. I was just using GICS industry and sub-industry levels. And Grainger actually has the highest correlation to Fastenal that I was able to find. It's about a 72% correlation, which is substantially higher than the next closest one. So there's definitely a relationship there. So we have, a weak in industrials and sort of manufacturing environment generally. We have a weak tape. We have potential catalysts in the form of Fastenal sales results, which, maybe they come out as a positive surprise. Stock's not trading like it, though. And this one, Grainger hasn't really experienced the same kind of weakness. Partially that could be because people might still be buying into those guidance numbers that they had provided. But let's also just take a quick peek now. I'm just going to go over here. We're going to just take a quick peek at, where this one is on a historical multiples basis. So I'm just going to get rid of the trailing numbers. This is going back 10 years. And what we can see is, pick your poison in terms of market valuations. Price to forward earnings, price to trailing earnings, price to book, price to sales, whatever it is, we're not far off of 10-year highs. So, weak tape, a comp that's trading more poorly is about to be releasing some numbers, not quarterly earnings numbers, but some earnings. Doesn't seem like a super healthy recipe to me. Of course, volatilities in many cases are higher than they have been. So different things you can do. One of them is something I was actually talking about in SPY actually so anybody who watched yesterday's live stream, I ended up using a number of those slides and I wrote an article for CNBC, which got published this morning. So if you're a CNBC Pro subscriber, you can read that article, and I talk about selling upside call spreads in SPY to try to take advantage of market weakness, the fact that we're only about 3%, now a little bit more off of the all-time highs in a higher vol environment, and just betting that we're not going to break out to new all-time highs by the first week of October. But you can do similar things in single stock land by selling upside call spreads, or selling upside call spreads to finance the purchase of a downside put. So basically making a full-on bearish bet with somewhat limited risk. Let's just take a quick peek at what something like that might look like for GWW. And here we go. I was actually not going out. So if you're going to sell call spreads, you don't necessarily, even though you know when the catalysts are, you're not trying to capture that elevated vol. You're just trying to capture elevated volatility and a market trend in general, not necessarily sell the event. So we know that it's the end of October. In fact, you don't even need to go out all the way to the end of October, but you can, sell a call spread. I think what was I looking at? The 9. I may have been looking at the stock price may have been a little bit higher at the time. So here you can say sell a 950, 970 call spread. You're going to collect about $6, a little over 30% of the distance between the strikes here. And that 970 is basically a stop, because we can see that these were those highs that we had back here. I don't know that we're going to retest those highs, frankly, within the next 2 weeks. That's the time frame of the trade that we're talking about here. And then, of course, you can re-up this trade if you wanted. If you are interested in buying premium, for example, buying a put spread to make a bearish bet, then my preference would be that you try to capture more potential events that could take it there. So that would include those October 31st, their earnings for them. Obviously, anything we do, whether we, is going to capture the sales results for Fastenal, because that's coming right out. But I think that's, I think there might be more of an opportunity to trade Grainger on what we're seeing in Fastenal than Fastenal itself if you're not already in the trade. And this is just trying to, look around corners a little bit. We could be getting that wrong. It just seems to me that 8 to 10% annual growth rate for Grainger, it does not feel like an environment for that. And Fastenal is not trading like that's the kind of environment we're in either. So you have a couple things going your way. What's the final thing that's going our way? Well, let's just take a look at some other short-term technical indicators. And these are not mine. I'm not going to be the ones drawing the line. We're going to just let the machines do it here. Again, as I always say, ignore this buy and hold line because that's just used for reference. What we can see here is, we've got 20 technical indicators, and of those, we've got 5. 5 that would be bullish here. And actually, one of these, one of these I was looking at, it might have been this moving average one here. It looked to me like that should actually have liquidated on today's weakness. And sure enough, there we are. Yeah, see? So even those that are bullish, that handful, the 25% that are bullish, today's weakness actually may have violated that. So this was the trigger to be long. You can see that wasn't necessarily a trade that really worked out, but it broke down below that exponential moving average. In this case, we're using the 50. So you actually, even if you had been in that trade on the long side, you'd have blown out of it. And the other thing we can see is that, and this is just the demonstration in this lower portion here. This is the P&L of using the exponential moving average. It does demonstrate that these, some of these technical approaches, they're going to work until they don't. And here you have a market momentum shift, and that market momentum shift having turned, neutral to bearish, just means that all of these things are just not working out so hot. So a lot of technical indicators suggesting some weakness. Fastenal falling more quickly, but probably the most correlated name to Grainger. So this is kind of playing the game of would you rather on the short side. I'm kind of leaning towards Grainger. And again, this is an effort to look around corners. Fastenal's creating the smoke. Maybe there's some fire here. So that is how I would trade that. So from there, let's see. Okay, I'm going to ignore concerns about audios. That some comments were made there. Hopefully everybody got to hear the more important and meaningful portions of this. Okay, how are you playing tomorrow's jobs report? I'm not actually playing, personally I'm not actually playing the jobs report specifically. And part of the reason for that is, this was it was a question that came up last week on Fast Money. And this is really a broad market thing, right? So as I've many times said, in general, everybody is, for the most part, unless you're Jim Chanos or whomever, you're going to be net long equities on balance. I am, probably everybody is. But certainly within the last couple of weeks, I've become much more concerned about equities over the course of the next, 8 to 10 weeks or so. The election is only one part of that. The fact that we have economic weakness is certainly a part of it as well. Here's the thing about the employment numbers, and this is what we were talking about last week. People were saying, oh, are you watching the Fed or are you watching payrolls? And I said, no, it's all the same thing, right? The reason people were looking at those numbers was they were trying to see whether those numbers could give them what they wanted, and what they wanted were lower rates. There's not really anything that payroll data can give us now that we don't already have, right? So everybody's expecting a cut. There's some debating about what the size of that cut's going to be. Is it 25? Is it 50? I think more and more people are sort of leaning towards 50. But it's almost not that important. A rate cut is the reason people were paying attention to it. So what can the jobs number provide us now? What detail can it give us? And that is that we're going to get the rate cut, or that things are worse than we expected. It's really as simple as that. So I don't see it as a circumstance. We could get a small bid to the market. Let's just say you get that Goldilocks number, still justifies a 25 to 50, but not so disastrous that it looks like economic calamity lurks. Well, here's the thing. We've been seeing negative revisions on the employment front, considerable negative revisions. And the net effect of that is that, there might be some discounting of people actually are handicapping a worse economic and employment condition than the jobs numbers, than the employment numbers would reveal regardless. So I kind of feel like if you try to think about the different things that could happen, for a while, before we actually had the Fed say we're now on a path to rate cuts, you could look at any one of these things, good, bad, or indifferent, and say two of these potential outcomes are generally good for equities and only one is bad. And that was the one that was going to make it difficult for a rate cut. Now that we have that, I actually think this is the inverse. Good, bad, or indifferent on the employment number, two of those potential outcomes are bad and only one is good. So it doesn't really change my calculus on how I think about the market's potential over the course of the next 8 to 10 weeks, if that makes sense. Okay, so I hope that helps. And by the way, I think what I had also added when I spoke about it last week was, 30 delta puts in SPY Qs. I think we've spoken about this with, there's more time, there's more nuance in these live streams than we have in a final trade on Fast Money. Obviously, as vol rises, you know, the appeal of something like a put spread does go up somewhat considerably. You know, VIX was over 20 when I was looking before. Where are we now? Still over 20. And what this means is that if you can imagine, what did we see the last time we saw VIX spike over 20? It came in pretty sharply. I'm not expecting that so much this time, but I'm just trying to illustrate how important this is, which is that a 30 delta put from, you know, over a period of about 2 trading days, just on volatility declines, you know, can lose a pretty significant percentage of its extrinsic value if you're going from an elevated volatility regime to a more normal ones. And, you know, what we saw before was we got that VIX spike, and then we had that Friday, I don't think it was this Friday, but the Friday before, whatever, you know, where the VIX ended up closing at 14.7. So pretty significant decline. And so if you're going to make a bearish bet, you're still going to try to target maybe 30 delta net-ish, maybe a little less. Choose a higher strike, put to get long, and then, you know, trade short put on the downside, just because vol's a little bit higher, and that mitigates that risk a little bit. On the other hand, if we catch a bid by some miracle, you know, that 1 out of 3 chance comes and we get a Goldilocks number tomorrow and the market catches a bid and vol comes in, then I would probably just look to trade an outright. So that's sort of what to do post jobs, payroll numbers, that kind of thing. Okay, so how would you, let's see, US Steel, let's take a look at US Steel. So Samir is asking, how would you play options on US Steel? So let's just take a look. First things first, I'm going to just take a quick peek at the events calendar. So this is pretty much everything that is going to be coming up. I'm just going to choose, I don't need the stuff that happened in the past, frankly. So we're just going to bump this out. There's really nothing until they do their quarterly earnings, other than broader economic data, until they report in late October. Let's take a quick peek at how the stock's performing from a technical perspective. And again, we're just going to sort of rely on the machine here to, so a couple quick things. We can see that more of the, I mean, we caught a nice bid today, huh? Did that violate anything? Let's see. I'm curious. So we were talking about moving averages. Let's see if we can take this exponential moving average, which was short, and see whether this one was violated by, no, not even close. No liquidation. Ooh. Yeah, that's, I don't really see that. Back this up a little bit more. What would be a potential area of support? Well, we have this unfilled gap right here, somewhat unhappily, although we are catching a nice bid in here. On an otherwise kind of not so great day. So let's also just take a quick peek at where we are in terms of valuation. On a historical basis, we'll try to go back. Let's start with 5 years. And get rid of the price graph, so we don't really need to look at that. Earnings gap, so I'm going to lose that. And what is this data here? That's obviously broken. So we obviously had some screwy. Let's get rid of EBITDA for a second and just expand this a little. All right, so about middle of the pack here. See whether there's been any sort of change in street view, net of these declines. We've got some analysts on the street are reaffirming their bullish stance. So Jefferies, Morgan, and BMO reaffirming their outperform or buys. But still, overall, we can see 4 buys, 5 holds, which is the street's version of a sell. Not immensely positive. Okay, and let's also take a look at vol and see what we have here. So this might actually be what presents some opportunity. You know, these higher vol environments, kind of like what we were talking about in the Capri case, are situations where you can actually short some premium but get some play into a directional move. Let's take a look out 3 months. So this one's got a little bit of a short sale restriction on it, looks like. We should get Jim Seligman back on the live stream so we can find out from him what he's seeing. It looks a bit as if, because of these high vols and probably wide bid, and let's just double check that actually. How wide are these spreads? Because options play is struggling to come up with some reference trades. That suggests that going out in time, we might be getting, these spreads aren't absolutely terrible. Bear in mind, so this is just, again, an important sort of public service announcement. When we start seeing vol moving up, when we start seeing price jumps, so discontinuous pricing, just be careful when you exercise your options. And also bear in mind that from one strike to the next, you can see very different, and actually we can see it right here, some very different pricing dynamics, which I think is kind of interesting. So for example, let's just take a look at October 11th weeklies in X. U.S. Steel. Notice, for example, that the 34 strike calls that expire on October 11th are almost $1.90 wide, 105 bid at 292. And so you definitely don't want to be throwing any market orders in there because you can buy the 33s for 156, and that's if you lift the offer, which is probably overpriced in sort of a bid-ask spread context. So you really want to make sure, if you're going to start trading on the option side in these things, that you are watching those limits really carefully. Look over here, the 30 strike puts, 113 at 282, $1.50 wide spread. The spread's basically as much as the option is actually worth. So putting any kind of market order or immediately marketable limit order, so even choosing that bid or offer, this is definitely something that you want to work. And in order to do that, you kind of need to take a look at the adjacent strikes to get some sense. So, for example, we know full well that you're not going to be getting these, at one point we saw these 33s, they're 90 bid, whatever. We know that there's not a very good chance that you're going to get those things off close to that bid or even close to $1. And why do we know that? And that's because we saw the 34s just a moment again where $1.04 bid and not getting hit, right? So that higher strike call is always going to be worth less than the lower strike one. So use those things as sort of a frame of reference. Find what looks to be the best offered option and the best bid option, and you're going to try to build a curve through those things to sort of help you establish what an appropriate limit order price for these things will be. So let's see though, because I was just curious to see whether it might be possible to construct a trade with these high vols. So I'm actually going to, we have a put here. We're going to see whether or not this might be another potential place where you could look at things like 1x2s. We're going to see whether that actually works. I don't know, haven't checked it, but we're just going to see what we've got here. So I have to switch that to put. So 220 round numbers, that's what those 29s are. I'm just looking at a near, look at that. So the 28's 157, the 27s are a penny. Yeah, I mean, that obviously doesn't make much sense. So that's $1.20. Where did I say that gap was, that unfilled gap? Let's go back real quick, because that's kind of what I'm keeping my eye on. Unfilled gap was back to right in here. We'll call it $24 round numbers. So $29.27 for a credit. That doesn't get you down to 24 yet. 26. That doesn't quite work. Yeah, I mean, we're struggling here a little bit because one of the things we can see is that I can't actually manually put a price in here, which I would like to. That's the kind of trade, though, that I would probably be looking for, trying to take advantage of the somewhat elevated vols. You might even be able to do 1x2s on both sides. So you're going to be taking the risk, of course, that you get short the stock, but at a considerably higher level, or long the stock at a considerably lower one, and then profitable within some range, bounded by the fact that that unfilled gap is definitely something that you got to keep your eye on. But the chances that it's going to make up this gap, because you're going to have a lot of ready sellers, a lot of inventory back at that $36 level or thereabouts, the chances that it gets above that, very, very slim. If for no other reason than that people who've been burned are going to be looking for the exits at that time. So yeah, something like this. And actually, let's think a little bit about what a trade like that looks like. Maybe we can construct that. Let me add some more legs so we can sort of see what this. Again, bear in mind that unfortunately, just because of these bid-ask spreads and the fact that they're really wonky on some of these strikes, it's not going to work out perfectly. So I'm going to construct the trade, but the prices that we're going to see are not necessarily going to be indicative of what you should be targeting or what you would actually get. I am Batman. But this is the kind of thing that I'm talking about. A situation where you're taking in a bit of premium, taking advantage of that elevated volatility. Something that Carter Worth likes to do, and this would arguably be a similar setup. Synthetically, what are you doing here? You're just selling a strangle. So effectively, that's kind of what you're looking at doing here. Willing to get long at a considerably lower level, and willing to get short at a considerably higher level, simply because there really is probably going to be some meaningful resistance up here if it gets anywhere close to that. I don't think it's going to. But when you start doing these types of things, so a 1x2 call spread is, when we use those as stock recovery strategies, you could think of those as a little bit of a covered call. They have similar characteristics. It's just that you're making a trade-off, that rather than collecting premium, you're sort of pushing the upside up a little bit. And the same thing with a 1x2 put spread rather than just a cash covered put. And you're sort of finessing the payout. Again, this is one where you're going to have to really be careful on your execution because these spreads are wide and so on. But you can see that the characteristics of that trade are reasonably attractive if you can get that level, and the probability of profit's not bad either. You're talking about, again, assuming you can get it off and you're being careful about your limits, almost a 2 in 3 shot that something like that's going to be profitable. And by the way, you should have a better than 50% probability of profit if you're taking in some premium, because you're almost always going to be doing that in situations where there are some meaningful risks. We've already seen a big gap, but we have some other catalysts, and those things are all coming to play. But I think the premium here is awfully juicy. So something to think about there. Okay. Marriott with the strike. So we're going to take a quick peek here. I am, you know, it's interesting. One wonders whether the current administration would endeavor to try to help encourage or broker agreements in strike situations, given that it's an election year. It doesn't look really good for those who are in power, I would think, if there's a lot of ongoing disputes with labor, especially if you're trying to promote yourself as the Labor Party. So just an aside there on whether, even if it's using the bully pulpit without actually taking direct involvement, but trying to lob comments that would encourage folks to identify some form of a resolution. So part of this is going to stem from what the demands are. So let's see. We've got the Unite Here union back on the job. 700 at Hilton San Diego are still on strike. And then we have these other locations. The fact that, the fact that some are actually back on the job already, this kind of speaks to what I'm talking about. Prolonged labor disputes just aren't going to show particularly well. I have a feeling that they're going to, to cave a little bit. That is to say, management. Again, nobody really needs or wants this. It's just, it's too disruptive. It's generally easier to, especially since some of these contracts can also push the problem out into somebody else's backyard sometimes. We've definitely seen that. We definitely have seen that with the UAW over the years. And this is a situation where it really it breaks the business completely. Unlike other types of industries, hospitality does not accommodate this kind of thing. You don't have any inventory to rely on. It's not like you, if you're an automaker and you still have a number of manufactured cars not yet on dealership lots, the lots themselves, have actually been seeing rising inventory, so they could actually tolerate slowdowns. And in fact, the automakers have slowed production in some cases, so they can actually tolerate this kind of thing. Hospitality doesn't really work that way. If you have a lot of people walk off the job, it's real time, day in, day out, and you need these people on the job or it just doesn't work. Which puts labor in a pretty decent position, I would have to say, in some locations. There are some places like San Francisco, where I'm in the Bay Area, where a lot of these hotels have really been struggling, and in some cases the owners have just been turning in the keys. They can't make the payments. But the bigger issue to me is just whether or not we're in an economic environment that is conducive to equities, whether it is conducive to, this is partially consumer discretionary, it's also some, business spending. But, this is your chart right here. You tell me what you see right here. This pink line highlighted now, that's the 50. This yellow line highlighted now is the 200. What do we got right here? The proverbial death cross. Not a great recipe. I mean, I hate to sound so pessimistic because in general, I'm not always, bearish. I know that it comes across that way sometimes on CNBC. You hear these guys, they're oftentimes pointing out risk, and some of them are almost perennial bears. As I pointed out, for the S&P more broadly, it grows faster than the economy. It tends to grow its way out of trouble. It's a better place to be than cash in the long term. But what we're really talking about right now, and what I think you're asking me is, because you're asking me about a labor dispute, is the short term. And the short term is not overwhelmingly positive, so we're going to take a look at some other technical indicators. Same exercise as always. try to follow the process, if you will. And it's pretty much a mixed bag. Again, eliminate number 41. And what we have is it's basically 50-50 bulls and bears. Let's see whether one of these happens to have been. So that was the buy juncture just here. And we are toying with it. So that's just using those moving averages. So if we go back to the backtest page, it doesn't really matter which one of these move. It's different mechanisms to smooth the same technical indicators in some respects, but whichever of these moving average indicators you look at, you can see that it's really very, very close. And I think the longer term 60 to 90 day picture is not all that positive. And we'll, just for thoroughness, for completeness, why don't we take a look at some some fundamental approaches as well. Now, bear in mind that this gets a little bit tricky because the industry was shut down. So I'm going to annotate here because I want you to just, in your mind's eye, I don't have an easy way to do this, but in your mind's eye, I want you to exclude, let's see if I can find an easy way to do this. That's not what I wanted. I want you to exclude from your calculations here basically everything that's in this sort of pandemic era period. So that actually, I should have extended that thing down to here, right? So even this low number doesn't really apply. High number doesn't apply either. But that's really not the thing that you're talking about. So instead, what we're going to do is now we're going to try to draw sort of a trend line through the price sales multiple, which is over here, which has actually sort of been, along with valuations generally, trending up. And if we exclude that data, which I think should be excluded, because how can you price a hotel on price to sales when they aren't taking any guests in? You obviously can't do that. It took quite a while for that to recover. And what we actually see is that the longer term trend was that there was some increase in multiples, but we're not far off of some real highs here, right? So you can think about this however you want. You can think about it from an economy standpoint. Is it going to be more of a tailwind or a headwind? You can think about it from a margins standpoint, more of a headwind or tailwind. Like I said, I think that labor is in a strong negotiating position, so that becomes a headwind. And then you have the broader market issues to contend with. I would say more of a headwind than a tailwind. Short-term technical indicators, it's a pair of twos. It's a toss-up there. But you can then say, on a longer-term basis, we did see that death cross. So on balance, I'm going to have to throw that into the negative column. And not that these other catalysts are necessarily going to be the most important thing. They're going to be reporting on November 1st, as we can see here. Anything else of note coming up that we should probably be paying attention to? Oops. Sorry. We didn't want that. That was just pulling up all events. I was thinking to myself, why is there a healthcare conference in here? That doesn't make any sense. Oh. We got something going on today. So Bank of America is holding a gaming and lodging conference, and Marriott presented. Interesting. Okay, so let's just quickly check. There's a chance that here we are. So just to get an update, I think this is probably not a bad idea if you're interested in Marriott. If you haven't already done this, So if you go to their investor webpage, you can see that at 9:20 this morning, they were participating in that B of A conference. And you can actually give this a listen. So go to the website and give it a listen. I think I'm going to do that when we wrap up here, because that could be interesting. That was okay. Okay. So Rodrigo, do you also trade SPX options or only SPY? I actually trade only SPX. I speak about SPY. If for people who've been watching the live stream for a while, they know this. This is kind of a force of habit thing. So let me talk about why I trade SPX. Actually, you said in the second part of your question, did I put this up there? I'm thinking of doing spreads on SPX because there's no assignment risk. What do you think? Yes. I only trade SPX. That's one of the reasons. Settles to cash. Force of habit is the other, because we use SPX commonly for, it's not applicable anymore, but it was very common for me to try to manage my net premium and keep that premium down. So if I was net long premium, I would sell SPX boxes, which is effectively a synthetic zero coupon bond, where it's a very clean offset for your premium. So it's very common for institutional options traders to use SPX options. In fact, SPX options are the biggest listed option, in equity land, period. The notional value of the open interest outstanding in SPX is considerably larger than SPY. Not that SPY isn't a hugely deep product. It is. And has all the liquidity in the world necessary for even almost any institutional investor you can name. As long as you fire your orders in judiciously. Remember that I believe it was Waddell and Reed that was, and this wasn't on the option side, but they were trading the futures, and some people blamed them, I think, for some market disruption that happened a number of years ago. You can look into that on your own. But SPX is a fine product. NDX is a fine product too. You can be sure to use limit orders, because the bid-ask spread in vol space in SPX, might be 50 bips wider than it is in SPY, but the real market is just as tight, right? So there's an inside market, and there's a reason you might think that would be the case, and that is that because it's an institutional product and because so much of it trades on the phones, they don't really need to advertise, if you will, by tightening up those spreads quite as much on the institutional side. So, but yeah, SPX is fine. NDX is also good. The downside to NDX for some is just that the notional size is going to be bigger. The notional size of SPX is also a little bit bigger, right? Because every contract notionally, so a synthetic in SPX is 500,000. So it's a little bit bigger because the multiplier is the same, still 100 multiplier, but the underlying is 10x, right? So that could be a consideration for some, but it's not a really big deal because, especially if you're trading spreads. If you're trading spreads, then, and by the way, spreads are one of those places where cash settlement is even more important in some ways because you can think about having a risk-controlled situation. Long or short a spread, your risk is defined up and until there's an assignment or an exercise. So if you own the option and you exercise early, and whether you go into expiration and it's an automatic exercise, you get a very different risk characteristic. So don't underestimate the risk of taking assignment or exercising into a position in the underlying long or short. Certainly one of the biggest trade issues or trade errors that I've ever seen, people who've watched the live stream, I know you've heard this before, was related to exactly that. It was IWM, and there was a position in some calls that was at a clearing firm, and they kind of lost track, and they didn't DK the trade on the right, and it never went to the right account. 6,800 calls. They ended up auto-exercising into, I think it was 684,000 shares of IWM. The bank that was holding that position actually saw their P&L swing to the good by, I think, about 7 million at one point, and they just kept holding on to it, and it went the other way, and the next thing you know, they had a many multi-million-dollar losers. I think it was in that neighborhood, $5 to $7 million loss, and they tried to put the trade back to me. Obviously, it didn't have anything to do with me, but somebody was trying to bail themselves out, and that was just due to an exercise. They were long calls. They were teeny calls, and they went into the money and they just sat around. And by the time somebody figured out what was going on, they owned the underlying in good size, and it was a huge loser. So SPX, that's fine. NDX, all of these are good products. By the way, the 60/40 tax treatment, the mixed straddles rule applies to both. I'm not giving any tax advice. So let me just throw that out there. Consult your own advisors and blah, 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 and maybe you're doing this in tax-deferred accounts. But that was a bit of a surprise to me. So I knew about the mixed straddles application of SPX options, and it was something that I always considered to be an asset, but then somebody told me that actually the same thing applies to the ETFs, I suppose for competitive reasons. Maybe that was something that they lobbied for, who knows. All right, Tucker D. Dog, happy birthday, Mike. Yes, it is my birthday. You get to a point where, unlike my teenagers, you don't necessarily celebrate it so much, but I am indeed another year older. Wiser? Don't know about that, but I am indeed another year older today. So, for those of you who elected to tune in, I don't know, maybe one of the people can tell me how long we've been going? 1 hour. I must have an internal clock that's getting used to the length of these things. So, there we are. We did one during trading hours. I hope very quickly. Oh, you know what? I missed one here. PC was asking about Broadcom. Let's just go really quickly before we go, and anybody can tune out who wants to. Not before you like, subscribe, and all that kind of good stuff. Tell your friends, whatever. So this one, quite unlike some other names, seems to have been holding up a little bit better. So let's just take a look. So first things first. Here we are, critical juncture, 143, 144-ish. That's the level that I would be just keeping my eye on. We'll start with that. Events that are on the calendar, things to be looking out for. We have, obviously, the big thing after the close. So so you're long, and I guess you're basically asking me, is there a mechanism to hedge this? Because you are long, didn't indicate that you were willing to. Let's take a look at what a quick put spread, just to hedge this thing. We'll use SEP regs. I think that's probably fine. I would probably not take something right at the money. I'm really looking at whether or not it violates those technical levels that I was more concerned about. So we're going to do this. And let's take a look at the implied move. Because that's really what I want to hedge against in case I get it wrong. So we're just going to take a look at tomorrow's straddle, 153, 154, 4.5, 9, 10. We'll call it $10 to keep the math easy, right? So 150.40. What's that going to cost you? Not terrible. Better than a 2-to-1 payout. Spending less than 3% of the underlier. And, it's going to capture that 150 day that I think is a critical level. So that's something you do. If you're long the stock, certainly it's doing better than a lot of other names have been. It's doing better than NVIDIA has lately. And we'll take a look at some valuations really quickly. I'm not going to look at price to earnings. You guys have probably noticed that lately I've just sort of been trying to take a look at price to sales. Another potential reason here, I would say. So you can ask yourself, fundamental tailwinds, but do you think that it makes some sense to hedge a little bit of your potential downside before the close when we get those numbers for less than 3% of the current stock price on a 2-to-1 payout, given the tape we're in? Yeah, I mean, that's a way you could potentially play it. Yeah, I'm glad I spotted that at the last minute, because that was one that couldn't wait. That was one that couldn't wait. So I hope that helps you, PC. And hey, middle of the trading day, busy day for all of you, I'm sure. And I'm deeply appreciative that you took some of that time to tune in and watch me. And I look forward to the next one, which is going to be next Monday, 4:15 Eastern Time. We're also going to be making some adjustments. So I've been doing this sort of stripped down setup so that I'd be able to travel, as I mentioned to you guys before. But I am doing sort of more of a permanent installation as we disassemble our pandemic gym that we had here. So treadmills and machines, all of that stuff is being removed so we can put in a studio here that I can just walk into at any hour. And hopefully that will simplify things. Thank you all very much for watching.